Welcome.
Hi.
Hello.
Looking forward to a fun conversation. So we have names and titles on the board, so we're just going to maybe jump in. We have a quick fire round, right? In one sentence, if you can do it. Tell me about what you're building, whether for consumer or institutional, and how vaults fit in. Debbie, start with you.
All right. Well, Privy builds wallet infrastructure, makes it really easy to embed money into your existing product. And where vaults fall into that is that the balances that you have in your product no longer have to sit idle.
Yeah, at Sentora, we do strategy management on vaults, so we are the vault product. Probably the best known one is Kraken Earn. We run a vault for the Kraken exchange.
Yeah, they do. Our product's DeFi Earn. We launched 8 weeks ago. Sentora, we're working with quite closely. I think we've done 150 million in assets in about 8 weeks. But vaults sit as a strategy layer, and we think about them as how do we use our distribution layer as Kraken and our exchange to kind of bring vaults to consumers in the apps they'll be able to use.
And we are Yo. Yo stands for Yield Optimizer, and we're creating savings accounts with Bitcoin, USD, Euro that are automatically optimized for yield across all of DeFi.
Okay, great. I'm going to start with you, Debbie, because I'm interested. Like, you sit across a wallet infrastructure, and you're seeing lots of different builders come to you with yield or earn programs. Like, what does that look like? What type of sophistication are you seeing? What type of variety, and what surprises you?
Yeah, I think I would say in the beginning, a lot of our customers had the idea for a general savings app, or rather they're connecting to vaults, they're connecting it to DeFi, where the clear use case is that this is a savings app that just does better than your regular bank account. I think what has been really interesting is that we're now seeing, it could be an app for something completely different. It could be a marketplace. And I think or it could be a payroll platform. And we're seeing these users now actually be interested in vaults and DeFi as a accompaniment to what the main product does. And so I think we're seeing this kind of shift in expectation or desire where no one is just building a savings product itself, and it's just really an add-on, and almost like yield is there by default.
Right. Calvin, to you, Kraken launched a phenomenally successful earn program. What did you guys learn in the first 2 weeks of launch of that product?
Yeah, I think we had a thesis we were operating out of, which is that we knew that users from the data that we had wanted yield, and they wanted access to stuff on chain. It's just a little bit complicated. We talk about the UX layer quite a bit. I think as we've focused in the last year on the application layer and how important that is, it's about abstracted experiences. And so, we knew that we had to kind of build something that was going to be really simple to understand for our users. And we have a pretty large consumer user base on the retail side. So I think we still have a lot to do. We just kind of launched phase 1 of this, but for us, it's about making it really simple and understanding kind of our own user data and how to kind of market to those users to something that's more simple for them to understand.
Is there friction that exists for the next cohort of users to come on? I mean, when you think about the product, what do you see as the challenge for onboarding the next set?
Yeah, I think you have to uncrypto it. People understand yield, generally. I think that I've been in crypto for 12 years, so you've seen us go really deep into the technical properties of stuff because we're so excited about the innovation potential.
Right.
We have to remember that people have been using phones and applications in finance for eons. And so the quicker we understand where the distribution points are, and these are for infrastructure providers like vaults, and how we do that distribution properly. Sentora is a really good example of a business that's understand this really, really well. I think Privy as well, everyone here. And so I think, when we try to figure out how do vaults now start to shift from just being just that distribution to rules-based finance, that's when we start to truly see it as product infrastructure rather than the product itself. which I think takes time for the industry to mature and understand, and also the participants that have distribution to buy into. And I think we're at that point of convergence where for companies like us, we see what's happening in the DeFi space. We want to offer simple experiences, and we know that it's been building for multiple years. So I think it's really easy for a company like us. Company that's a little bit more TradFi is going to take a little bit more time. But yeah.
Okay. Mehdi, do users care about vaults? Like, they don't see it, right? They interact with a different interface. Can you talk a bit about like how vaults sit with you, how that interface looks like with customers? Are they aware?
Yeah, I think to build on Calvin's, people don't care about vaults. They don't care about chains. They don't care about protocols. They actually just want the yield. And so that's 80% of the users that we need to onboard going forward. We need to uncrypt it, and we need to make it actually simple. But as we make things simple, we can also hide the complexity. It's good, but we don't want to hide the risks. And so that's always like, how much transparency do we need to give while keeping that user experience easy? On you can put any asset, USDC, USDT, you can put it from any chain, Ethereum base. It just generates yield. You don't need to really know where the yield comes from, but you can know where the yield comes from. And I think that's the kind of user experience that is needed everywhere.
So that's an excellent point. How do you balance that simplicity and lack of friction with letting the user know about risk?
Yeah, so we have to respect the manifesto of crypto about transparency and all of that. But we also need to prioritize the information for the user. So when the user comes in, the first page, they're just going to see a yield chart, and a certain performance. We're not going to say USDC, we're going to say USD. We're not going to say Euro C, Euro CV, it's just Euro. And it looks as simple as a traditional finance product. It looks as simple as a savings account, potentially. And then we give the tabs, we give like UX, that's a UI that allows the user to actually deep dive. And you can get to the bottom of like actually choosing what are the pools that you want.
Okay. Gabriel, I want to go to you. Sentora have been extremely successful over a short period of time as a curator. My own personal experience seeing them on Morpho, as you guys are very sophisticated. One of the challenges, as you will know, is as we think about long-term durable demand, we can think about incentives, but DeFi is still pretty mercenary. How do you think in Sentora about building that demand? What sort of strategies do you look at when you think about the type of borrowers that come in and what they need?
In terms of the borrowers, I think the beauty of DeFi is that you have everyone interacting with each other. You have institutions. You have just someone in their house interacting with them, being counterparties to each other, and so. While you need to understand and kind of categorize these flows, they all serve their purposes. I wouldn't say that there's a good or bad flow. They all have moments in time where they can be helpful. Incentives can be quite beneficial when you're trying to bootstrap a vault, and then you just have to really make sure that you have some sort of tapering program in place to keep that capital there, so you don't want to have sharp fluctuations, because that's what makes people leave. But if it slowly drops down and you're still performing as the same as other vaults or similar, you usually will get stickier capital. In terms of like strategy setup, it really depends. At least from our side, we do a lot of like pretty deep due diligence on collaterals that we use, so we're maybe a little bit slower on collateral additions, but we usually are trying to look for things that have staying effects. So while these incentives can be quite interesting at the beginning, the end goal is always to have yields on the vaults that are not driven by incentives, or even something that's quite DeFi native. Like, it's always helpful to have something like an Athena asset on there that has a certain strategy that can generate organic yields from their products, but then real world assets as well, having this diversity can make it so the vault stays at a pretty constant level without having fluctuations between the different industries that the yield is coming from.
I'm curious, when working with Kraken, what are the type of things you think about when exploring strategies for yield generation? You know, as a research analyst, you're kind of like looking at risk, but then also looking at return. At a broad level, like what are the top 2 or 3 things from a criteria perspective that you care about?
I mean, the risks are definitely the top. The biggest one that probably people don't really talk about because it's not so sexy on vaults is operation execution. You know, if you're doing some sort of loop or if you're doing any types of trades, there's slippage, there's price impact, there's places where you can eat away at the yields that you're trying to generate. And so this comes back to this durability of the returns. You don't want to have to flip between strategies and assets constantly because that price impact, and you know, if there's not a lot of liquidity at the point you have to exit a position, you're just going to hemorrhage on your yields. And so, you know, you want to find that fine point between something being durable and also having a high return, and then look at that and see, is there the liquidity needed to exit in the size you're looking at? Because running a vault at 100 million can be manageable. Running a vault at 500 million or $1 billion, this is a different ballgame when you're trying to manage that position in DeFi.
That kind of brings me to the next point of, and maybe a question for the panel. What do you think needs to be in place operationally, legally, and even considering the regulatory framework that you're operating under for a large fintech to think about coming into DeFi for a yield product? So, like, I've had lots of conversations around this and spend more time with I love attorneys, but like spending lots of time with attorneys. But there are real questions, real concerns, real risks. Some of it's just knowledge, but other, you know, when you get to like level 2, there's real sophistication in trying to understand, in a bankruptcy case, who owns the funds when they're sitting in a smart contract. So what are the things that need to be in place, you think, to be able for a DeFi or for a large fintech to come and say, I'm comfortable with this? I'd be curious about some of your conversations. Maybe starting with you, Mehdi.
I think it comes down to 2 things. The first one is risk. They need to be comfortable with the risk. And in DeFi, you have all types of risk.
Do you think they understand the risk?
They don't. But we have to do the work. We know DeFi. We know that a leverage position is high risk. We know that code that is not battle tested, that is not audited, is riskier, and so on and so on. And so the first thing is that we need to, I think we all do in this industry, talk about risk-adjusted yield now, and that's something that's important. And the more we do that, and the more we show that the returns make sense, the better the adoption. I think there is something else that we don't talk about, though, which is the securities law risk. And as we put humans in those vaults that have to do actions, we are creating potentially a security. And so one of the things that I think that we are going to be working on more and more is to take out the human aspect as much as possible by making everything algorithmic. So the algorithm to allocate should be an algorithm, not necessarily a human, and it is totally possible to do that. The trades themselves that you spoke about, I think we can make them automated. And as we do that, the vaults become less of a security there. Obviously, everything that is inside as well should not be a security. Like an asset like ETH is not security. An asset like USDC is not a security. A protocol that is like Morpho is not creating any securities risk. But so if everything is DeFi, if everything is not a security, then we're doing something that is sustainable for traditional finance to come in without that issue on top.
Yeah, I think he covered a good amount there. I think for me, I think about like what's required for, a product to be regulated. There's audit trails. There's the quantification of risk. And I think it's like, to his point, making it a lot simpler. Like we know the choke points where risk is. I think that needs to be explained and translated in a way that regulators are going to understand. I think part of like where we get to is like a sandbox in which like there's more of a feedback loop as we iterate. It's often missing in crypto. It's gotten a lot better. I won't lie about that. But I think that to build and innovate, there's like a dichotomy of innovation and then regulation. They're almost like opposing forces in a way.
And are you talking about feedback from, you're talking about consumer feedback or feedback from a regulatory perspective?
Feedback
right?
from a regular perspective.
Right, okay.
I think the consumer feedback's also important, but that's on like how they understand risk. I think transparency on where yield comes from is also really, really important. To your earlier point about incentives, like we haven't ran incentives, so rewards come from actual borrower demand for DeFi earn. I think people don't really understand that, right? Like we have incentives, we have like yields that are like astronomically high. The majority of the adoption has come from like people that are native to the space, and therefore they've become a little bit accustomed to really high astronomical APYs. So I think distribution through platforms like exactly what Kraken's doing gets it to like regular users. And like now the adoption curve of regular users using this, and a company like us using this, we have to go through that process and figure that out with regulators. And we have those comms and open lines, right? And so I think a framework needs to be established, but that only happens when you have like that feedback loop between product and regulators and like a high frequency. Because we've kind of gone too far, right? Like in a lot of ways, in a lot of areas, not just like for vaults, but for everything. And we're getting pretty deep. And I think like we've sped up a lot on the regulation side, but for the majority of the industry, we've been behind, right? And so I think that needs to converge a little bit more.
I mean, Kraken are one of the innovators. I mean, globally, when we think about, both from a license perspective and the coverage that you have, as well as product innovation, you've been at the forefront. I'm curious, what are the questions, if you can share, that regulators ask across different jurisdictions? What do they care about?
They care if we're focusing on the perspective if we're protecting consumer interest, right? Like we have to be the ones responsible for the products that we release to our users. And so if we want to innovate, right, we have to kind of go into sometimes newer areas. So a lot of the times for a larger institution, we have to wait, right? Like we have to wait, we have to see kind of what happens in the space from when there is an early concept or something that's new and novel, and let that go through a couple iterations where it's palpable to like put into a larger ecosystem like ours. But yeah, I can't pinpoint any specific. We get a lot of questions.
Yeah, I'm sure. Gabriel, if a large asset manager comes to you and says, "We want to work with you on curation," what are the first three qualifying questions you would ask them to kind of understand? Are they aware of the risks? Do they know the space? Do they have the resources? Like, how do you think about qualifying capital allocators?
As in deploying into the lending side?
Yes.
It's even within kind of, let's call them DeFi native institutions, there's a big breadth of understanding of the DeFi space. So centralized exchanges can range in what they understand, how they deploy, what sort of team they have for on-chain deployments. In terms of what questions we ask, I don't necessarily say we have any like specific questions, but we have, like, as Sentora has evolved, previously we were into the block, and for years we have been working with institutions in our smart yields product. So rather than through like vault infrastructure, it was just client-based strategies that we deployed. And from here, we manage a lot of the monitoring and the risks here. And so we were able to kind of gauge from conversations with them what kind of exposures they want. And especially with how modular protocols have ended up developing, we can still do that to some extent. We can set up a vault, but then potentially have some sort of sub-vault system in between if certain clients want to reduce their exposure to different items. But as of right now, I would say most people come and they're interested for our integration because they know that we can deploy in size. And then the conversation goes, we present strategies to them, and then we start to funnel down to the ideal strategies based on if they're hesitant on certain things or if they have specific red lines on assets that they want exposure to. And then often we're providing any of our due diligence we have on these and our metrics and our data that we present for these different assets. So somewhat bespoke for each person, but I would say it varies greatly on what people are excited to be exposed to, how risky they want. And sometimes there's a disconnect on saying, I want this sort of benchmark, but I don't want to be exposed to anything presenting that. And so there's sometimes a reckoning that has to happen as well.
Okay. Debbie, I have a personal question. I was in Mexico 2 weeks ago at a fabulous Stripe event, and it was really interesting for me to watch a company like Stripe bring together Privy and Bridge into the mothership. It was a unique conference in that it wasn't a traditional crypto conference, right? I had a conversation with a company from Argentina who were a B2B provider for like really SMEs, physical therapists, hairdressers, and it kind of struck me as we were listening to these conversations on stage with Zach and Henry, how normal businesses thought about crypto and stable coins, and we're talking about fairly sophisticated risk management strategies within vaults. But tell me, what are your impressions there of Privy, Bridge kind of coming together within the Stripe mothership? How has that been going?
Yeah, no, I would say it's been going great, and I mean, I think a lot of it too is that we are all parts of different forms of the stack. I think actually just even to tack onto your earlier question on how do we make these products, regulatory compliant, even for Kraken end product that goes through Privy wallets, so Kraken having been a centralized exchange uses signs for it to go to a non-custodial wallet, which then connects to the vaults. And so, without that non-custodial setup, it will be a lot more challenging for, for a regulated institution to, really plug into DeFi. So I think, Privy, has that custodial and non-custodial setup, allows somebody to have that side by side. So essentially, they could have the flexibility of connecting into open, decentralized markets from day one, or if they prefer to adopt a custody solution, they can do so as well. And I think some of the businesses that you met in Mexico a couple of weeks ago, they may have a little bit more of a conservative stance as it comes to custody. And we're able to do that a lot more quickly and have this kind of custodial and non-custodial side-by-side solution more quickly because we're able to work with Bridge as a licensed custodian from day one. And obviously we're looking to continue to expand our custody partner network so that we can cover more geographies in places where Bridge is unlicensed. But I think, kind of being under this, Stripe family of companies, if you will, I think definitely allows us to move faster. I think at the same time, both companies have their own individual, and three, if you include Stripe, all three companies have their own individual roadmaps. I think we operate at with different paces, with different, Privy is a 60-person company relative to Stripe, which is a 10,000-person company. So naturally we operate at different speeds and again have different priorities. But I do think that it's exciting to see where there are natural overlaps and deeper product integrations that, hopefully we'll be seeing, over the rest of this year.
And I don't know if you can share, but Cam, who kind of leads your go-to-market team, when does the Vault conversation or the Earn conversation or the DeFi conversation come up with Privy?
Yeah, I mean, I think a lot of, like I said, I think a lot of people are coming to Privy. I think, in some sense, because I think the wallet is basically the account layer, right? So regardless of whatever you're doing with crypto or with stable coins, like you need a place to hold them. And so I think people come to Privy and be like, oh, well, what else can I do with these accounts? And now these accounts are highly programmable, highly modular, highly flexible, and can connect seamlessly into these vaults. Now I think we've built, this was always doable before, but I think now we've extracted away the complexity even more. So not just making it easy for the end user, but making it easy for the developer as well. And so now it's really easy to earn on idle balances that you have in Privy wallets that, again, connects to a Morpho vault, through, that have been, carefully curated. And so, I think we're seeing a lot of people now being, it's as simple as like, let me just turn it on. I just want to turn on the button to earn, and then I can toggle how much revenue share that I want to have between their end users and themselves. And I think sitting as Privy, I think our mission has always been the same from day one. It's like, how do you make it as easy as possible for developers to build on crypto rails? I think we're doing that now just with an evolving, in the beginning, I think when we talk about developers, we're talking about like, independent crypto developers. And I think the space has matured so much over the past few years where these developers that we're talking to could be a Mexican-based business serving SMEs.
I want to shift the conversation just to institutions and kind of how we think about any conversations that you've had with institutions and how they may be different from some of the consumer conversations that we've had. So what specifically do you think needs to change today in terms of vault architecture for it to be a robust, or does it need to change in order to offer a more robust offering to institutions? Let me start with you.
Yeah, I think there's a different set of like parameters for each segment, right? And so I think for where we've been at with vaults currently, it's been focused on the consumers directly with vaults and then like through this distribution layer. I think we've been in discovery a lot. So like we've heard different things that are important to different institutions in terms of like what they're trying to bring to market. I can't pinpoint anything specific because it's like the same general things that we've seen on the consumer side, but more around like rules-based finance, generally speaking. I think vaults are starting to become a central piece of like, how do we think about this as a smart bank and like routing layer? And so I think the stuff we're doing with DeFi Earn, for example, with Sentora on the strategy curation side, I think institutions are looking for what's like real yield and like what is like this incentive stuff that's been going on here. How do we mature this and make it palpable for like the way that we interact in the world? I think it's two different worlds. And so I think this year will be a lot of discovery for us, but we've heard a variety of things.
One of the things I'm curious about is how does real-world assets fit into that yield strategy? Is that something you guys are looking at? How close are we to that? We have a market today on Morpho that's robust, 15 to 20 real-world assets. But as we think about them as being a central, consistent component of yield, how are you guys thinking about that?
Yeah, I mean, we have X stocks that we've been working on quite deeply. We had a hackathon yesterday. So I think RWA is also a really large focus area for us. I think everywhere in finance there is like a real yield in the existing world to be used. And so, stocks is kind of like where we're starting. But there's more other asset classes that we'll start to get into. But it'll be a central theme for us Q3, Q4.
Yeah, I think RWAs are a really interesting new source of yield, especially that we have seen some yield compression over the past few years on everything, every yield coming from DeFi itself, from market making becoming more efficient, from more and more staking being used, from like having enough liquidity for lending. So RWAs are actually the fastest growing component of the yield sources. It's still relatively small, but it's important for us to differentiate between two types of RWAs. There's the RWAs that are just like wrapping the treasuries. Those are easy to understand. The counterparty is the US Treasury. There is not so much, there's a lot of clarity on the custody of these things. And then there is like private credit. If you look at private credit today, there is a lot of private credit coming in. And it worries me a lot because there the counterparty is not as reliable. They can.
When you say not as reliable, what do you mean?
So the first thing is that we don't understand what's the underlying of the private credit most of the time. It's tokenized, a lot of corporate credits, and it's really hard for us to understand what's the bottom of that financial instrument. And so what I see around in this industry is more and more of these like private credit that could be an adverse selection case where they couldn't sell it on TradFi, BlackRock is closing on redemptions, and all of a sudden we're receiving all these RWAs with private credit. And so that's something that I think as an industry we need to be careful about.
But don't you think that as DeFi matures and RWAs come in, that transparency of those assets is going to be vital. In order for them to survive and grow, we need to understand what's the underlying, what's the pricing, what's the liquidity, and frequency of redemption. Those are going to be essential, right?
Absolutely, but this is like mixing two worlds. You're mixing the traditional finance world or the real space, mid-space world with the metaverse. And for someone, for example, to have the right to redemption, it's permissionless in DeFi. Well, it's not permissionless in traditional finance. Resolve today, Labs, has had a hack and blocked redemptions on RLP. And so that's something where when you have a human in the middle, you can end up with like not being able to have your redemptions and not being able to have your rights. And so when we bring in private credit, we're bringing in new types of risks that we're not used to in DeFi that make the case more complicated. And you talked about transparency. I think we have full transparency on chain. We are able to get to the bottom of like exactly how this yield comes from. Whereas like when you have like a mix of these, where you're bringing in an RWA that is complicated, if they don't provide you the transparency, well, you're not going to have it. And people are still like investing in these. And the best transparency that they can do is probably quarterly audits. Well, over a quarter, there's a lot that can happen. And so I'm bracing for some pain for the coming few years where we will finally see problems with redemptions on private credit, which are the problems that already exist in traditional finance. We're probably going to see them in DeFi as well.
I feel like what he's describing sounds very much like 2008, you know, and all of that opacity in terms of all of these derivative products that nobody really understands, and they're like nested one in another and another. So yeah, that's like that would be a very scary situation.
Gabriel, curious to you, RWA is essential for consistent yield strategies?
The consistent yield strategies come from having diversification of where the yield sources are. And so RWAs can be a component of this. Personally, I don't really like the term of RWAs because I feel like it just clumps a lot together that, as Mehdi pointed out, is actually a very diverse product range. Like, are you backed by mortgages or some derivative of a mortgage? Is it private credit? Is it T-bills? Is it payment, like short-term loans for payment transfers? I think someone else was having a key point about that earlier. And these all have different risks, and you have different duration exposure, and these things matter a lot. Coming back as well to the reporting, right? These guys can try and put as much as they can on chain, but there's a latency and a lag, a gap on how reporting is on chain, which is block by block, or stuff at a institution that's working in the real world, which can be daily at best maybe, but not the weekends. And so you need to, when you're bringing on these real world assets, you need to really be very careful on how you integrate them. And so they will bring a lot of benefits, but they will also, if curators especially are not paying attention, could backfire quite easily. So whether it's not, you know, people think that it's a stable coin because it's actually kind of an accrual token, and it starts at $1 and it accrues or if it's actually just, there could be drawdowns, which we've seen with like Fasanara, that they had a drawdown that I don't think it affected anybody, but these sorts of things are real risks that you run. On top of it, depending on what type of real world assets you're bringing on, when are they trading, when are they liquid on-chain and off-chain, how can you redeem them, can liquidators act on these? You know, we've been working a lot with Backed, with Ondo, on bringing like lending markets for security stocks, and trying to create the oracles in a way that you have circuit breakers, that you have different preventative systems in place to make sure that if there is a stock, the stocks get divided, or if there's a distribution, that those oracles reflect, and it doesn't reflects the correct price, and it doesn't put you in a situation where you have bad debt or liquidations on chain that aren't going to get liquidated because you have to wait for some sort of KYC liquidator to come in and make that liquidation. So there's a lot to be wary of. I think we'll see some unfortunate missteps, but in the long run, we'll see RWAs on chain, and I think it'll probably become one of the largest asset classes in DeFi.
When do we get there?
I think there's a lot of bubbling about private credit companies having issues. If that ends up falling, it might take a little longer, but we're already seeing it, and I think in the next year we'll start to see structured products that are managed products in a way that is safe for users. I mean, that's what we're working on. We have conversations with several different real-world asset providers on how we can manage their integrations into DeFi. So I would hope to see more in the next year, but if we see some TradFi stuff start to break down, it might get extended before we see real uptake.
Okay. We have less than a minute left, so we'll just do a quick fire question round. What is the vault-powered consumer product that exists 18 months from now that that you're excited about? What is, as we look into the future, what needs to change from today to get to a place that we're offering something that is a V2 of what we have today?
I'd say a curator-less vault, maybe something where the curator just comes in.
So Gabriel doesn't have a job then?
I think he does have a job, but he has a job in the beginning.
We're already doing beta testing on it, so okay. I might have to find another job soon enough.
Okay, so you've just got 10 agents doing your job, is that right?
It's in the pipeline for us, so okay. I have to be careful.
Okay,
we're
hiring
all race for this with AI as well.
Yeah, I think for me it's just like a completely agentic powered vaults.
Protection and cover at scale. So Sentora is incubating a protocol called Firelight that is looking to provide cover for vaults to allow users to have some sort of protections on exploits, technical and economic. This will be coming soon, and it's meant for institutions to be able to integrate into their products at scale.
Great.
Yeah, I think for me it's being kind of the wallet layer. Like I think I just see every single app is just basically a global programmable savings account that can seamlessly plug into any of these protocols.